Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss why some investors are now worried about a recession and how this has impacted the financial markets. The S&P 500 and NASDAQ are now down year to date, driven by tariff concerns and mixed economic signals. Despite this uncertainty, it's important for investors to maintain perspective by distinguishing between personal economic experiences and factors that drive financial markets. Economic uncertainty and periods of slower growth are normal during business cycles. It's important to take these in stride with a balanced portfolio and a customized financial plan. Over the next few minutes, we'll discuss some key insights on these topics. First, as this chart illustrates, tariffs and other policy changes have caused economic policy uncertainty to rise. In fact, some measures of uncertainty are as high as they were during the 2020 pandemic and the 2008 global financial crisis. However, it's important to keep this in perspective. Some investors and economists have been forecasting a recession for 3 years now. Not only has there not been a recession, but the stock market has performed extremely well in recent years. This highlights that economic forecasts can often be wrong. Even more academic indicators like the inverted yield curve or the so-called SOM rule have not proven to be correct this time. That said, recessions are a normal part of the business cycle. Basing investment decisions on constant recession predictions can lead to poor financial outcomes. Instead, it's far more important to have a financial plan that can withstand all parts of the cycle. Next, this chart shows the quarterly GDP growth at a seasonally adjusted annual rate for the past several quarters. Growth has been stronger than many expected. Consumer spending has helped to support the economy, and many hope that business spending will pick up too. So, why are some worried about a recession? This is because some recent economic data has been mixed. Inflation exceeded 3% for the first time since last summer, stoking fears of rising prices. Also, federal jobs fell by 10,000 in February, sparking fears of a broader slowdown in the job market. Consumer sentiment has also worsened, with the 5-year inflation expectations at 3.5%, the highest since 1995, and deep pessimism about future financial situations. It's important to remember why markets were optimistic after last November's presidential election. While tariffs may be a shock to the global economy, many still hope that changing policies around manufacturing, energy, and taxes could boost growth in the longer run. Finally, it's important to remember that market pullbacks are a natural part of investing. As this chart shows, the market typically experiences multiple pullbacks each year. Research shows that staying invested through market turbulence yields better long-term results than attempting to time the market, as missing just a few of the market's best days can significantly reduce returns. We hope you found these insights helpful. If you would like to discuss the markets and recession risk in more detail, please don't hesitate to reach out. We look forward to speaking with you soon.